9 a.m. in Shanghai, Shenzhen, and here in Hong Kong, you're watching The China Show. I'm Yvonne Man with David Ingles.
Good morning. Happy Friday. We are counting down to the open of markets in Greater China. Our top stories today, TSMC shares in focus, up and running 2.5% in the opening minute here, coming online after it reported blowout earnings, leading to a jump in its U.S. listing on the highest trading volume in 9 months.
Yep, and we spoke to the CFO who told us the company plans to raise spending to meet the growing demand for AI chips.
In the next 3 years, the total capex is going to be significantly higher than the number in the past 3 years. So that is evidence of our strong conviction in the AI megatrend.
We're getting mixed trading elsewhere in Asia amid some losses, as you can see over in Japan. Treasuries under pressure following an unexpected drop in U.S. jobless claims.
And China's central bank says it sees more space for more easing this year after announcing a rate cut amid shrinking demand for new loans.
Good morning. Welcome to the program. First things first, a look at the AI bellwether just after the opening bell. TSMC 3% to the upside, lifting the Taiwanese benchmark 2% up. 4% was the move overnight in the U.S. listing, as we were pointing out, of course, the highest volume in about 9 months or so. Some of the other suppliers of TSMC also coming out of the gates very, very strong. We'll talk more about this and what this means for the broader AI trade in a moment here. As we were pointing out, apart from Japan, the rest of the region doing okay. Singapore is also coming online. Asia Pacific benchmark, bottom of your screens. This long AI trade, as we were just pointing out, refreshed by the outlook coming out of TSMC. There's also, of course, separately, but certainly related to that, is the trade deal coming through between the U.S. and China. More on that in a moment. U.S. futures, you have silver coming through. A look at the dollar and, of course, the U.S. 10-year yield on your screen. Just going into the open today, A50 futures coming online. The 2s and 10s in focus. The curve also in focus, too. Steeper is still what's expected after the pronouncements coming through out of the press briefing yesterday. A cut at one of the interest rates. Does that open the door to more, or is that the easing that you'll get for now coming through out of the PBOC? Lots of conversations to get into the next 2 hours or so.
Yeah, seems to be right now quite targeted. We'll see what this means for some of the more key sort of policy rates and moving forward here. But certainly that was quite significant in that press briefing that happened yesterday. But really, it brings us back to Taiwan, given the news flow, right? You have TSMC, that massive cash commitment when it comes to the guidance on CapEx is certainly what moved the market, I believe. Even Taiwan dollar on the back of those results. So it maybe does confirm maybe this AI cycle is actually still quite strong, accelerating, not really slowing down.
Yeah, it really did move the needle, I think, when it came out post the close yesterday in Taiwan, and then you had immediately the move over in Europe, some of the proxies in the U.S. and going into the session today. And I think I also want to point out at 17:30. So following the release of the numbers, obviously the sell side came in quite strong. We had revisions in the order of about 7% to the upside on the consensus price target, which is now sits north of 2,100 on the 12-month consensus. So that effectively reflects still a 15% upside from current levels. But again, the risk to CapEx, what does it mean if they don't spend that? And obviously how this actually goes into the geopolitics of things and how much they, as a company, will actually be spending in the U.S.
I think what the CEO says, C.C. Wei, about this gap between supply and demand is what he is most concerned about and how they're going to actually bridge that gap.
Yeah.
But yes, if they can deliver on these pledges in this U.S.-Taiwan trade deal, that's certainly one part of it. But also when it comes to the guidance, as you mentioned, right, when you're talking north of $50 billion, that's certainly what did surprise the market and really blew out the consensus out there as well. So how does it all fit in? The TSMC story with this U.S. and Taiwan trade deal, that both have agreed to this trade pact that would lower tariffs on goods from the island to 15%. Putting it in line with what we see in Japan, in Korea as well. In return, Taiwanese semiconductor companies will increase financing for their American operations by $500 billion, and that does include at least $250 billion in direct investments to expand chips, energy, and AI facilities. Now, TSMC says it will try to speed up the transfer of its advanced chip-making expertise to the U.S. while continuing to develop and maintain its top fabrication techniques at home. The CFO, Wang, telling us that even with faster transfers, it would still take at least a year for mass foreign production of its leading technology.
We don't look at it this way. It really depends on customer demand. In the US, a lot of customer wants to go there, so we will expand over there. But for the leading edge technologies, it will be in Taiwan because it's a heavy cooperation between the R&D people and operation people for practical reasons.
And leading edge will continue to be led by Taiwan, you think, over
Yes.
the US market, and that no changes to that at all, even with you adding a lot more capacity in the States?
Yeah, that's for practical reasons.
Is it possible, though, to speed up how quickly that advanced tech can be shifted from Taiwan to the States?
Yeah, we can try to do that, to shorten the gap.
What does that transfer gap look like then? If right now it's several years, Taiwan is ahead, what does that actually look like in the future?
We don't have a specific timeline now, but we can try to accelerate that. We think we can try to accelerate.
Could it be shortened to months, do you think?
It will be difficult, challenging.
Okay, so it stays at least one year behind then.
Yeah, there we go. The CFO of TSMC, Wang, there with Bell, of course, there in Taipei. Now, the other big story, of course, apart from that, is almost at about the same time, just shortly after TSMC released results, was this briefing coming through separately in Beijing out of the PBOC, in which they outlined a few things. One was they lowered interest rates on its structural monetary policy tool. It's effective in about 2 or 3 days, January 19th, 25 basis points early next week. The other more broader message there is that they did see more room for easing, whether that's triple R or the policy rate, signaling it does have room to further reduce borrowing costs while stepping up targeted support for the economy.
The PBOC will cut the interest rates on all structural monetary policy tools by 0.25 percentage points. The one-year real-lending rate will be reduced from 1.5% to 1.25%, with rates for other maturities adjusted accordingly. The central bank will integrate the use of its real-lending and rediscount quotas to support agriculture and small businesses, with an additional 500 billion yuan allocated to the real-lending facility.
And, we also got the lending numbers for December, the aggregate numbers. This is specifically the graphic on your screen, which is new loans. The total for 2025, as you can see, is a step down from previous years, despite the uptick that we had in December and also the uptick still in aggregate financing overall. It's a reflection, this specific one, of sluggish growth from borrowers that's really weighing on the outlook.
Yeah, joining us now is Ding Shuang, Chief Economist for Greater China and North Asia at Standard Chartered Bank. Ding Shuang, it's always great to have you. Happy New Year. So we're kicking off the new year with some cuts from the PBOC. What do you make of the timing of this? And is this just the beginning, do you think, in terms of stimulus?
Well, as the Deputy Governor said, there is room to cut policy rate. But the room is not that large, in my view, and it will be used very sparingly and focusing on its signaling effect. Take the lending rate cut, for example, 25 basis point. It's large, but the market reaction quite short-lived. If we look at the Hang Seng Index, 10-year Chinese government bond, the reaction is very short-lived. That is understandable because while these tools are very beneficial for selected industries, technology, green development, SME, agriculture, its macro impact is very limited. Look at the total scale of the relending, perhaps just 5 to 6 trillion compared with 270 trillion of credit outstanding. So the market will naturally focus on the real policy rate, that is 7-day reverse repo rate. And for that, I think the room for cut is still constrained by the net interest margin, which is at 1.4%, record low.
Yeah.
And at the planning meeting of the PBOC early this month, the PBOC said they will try to keep the financing cost at low levels instead of continue to lead it lower. So that's an indication that any policy rate cut will be used as indicated in the Central Economic Conference, efficiently and flexibly. So we think, all things considered, there is room to cut the policy rate in the second quarter by 10 basis points. That's our forecast. And the monetary policy support may mostly take the form of liquidity injection to prevent the government bond yield from rising. So we forecast, for example, a 25 basis point reserve requirement ratio in the first quarter, and supported by regular purchase of PBOC in the open market of the central government bonds.
What does it mean for the currency and the policy around the currency, which I think they pushed back? They said the strength in the currency recently was because of the weakness in the dollar and not a fundamental shift in their attitudes towards the renminbi.
I would say the PBOC appears more receptive to a gradual appreciation of the currency. And I think it's mainly because it is supported by the fundamental and China's focus on technology, on industrial upgrading, that is making Chinese product more competitive. And some appreciation of the currency can help to ease the trade tensions, not only with the US, but also with Europe, with other trading partners. So looking at the trade data, China's export grew by 5.5% last year, despite the high tariff. China's trade surplus, $1.2 trillion, record high. China's current account surplus, our estimate is 3.3% of GDP. That would be the highest in the last 15 years. And this trend is likely to continue going forward. So we think 2 to 3% of appreciation of the currency is not going to undermine China's exports. And also, if we look more broadly, we think China's strong renminbi policy is taking shape as China is trying to develop a financially strong nation. President Xi Jinping said that a strong currency is the first key core element of a financially strong nation. So we are going to see more government policies aligned to promote the global status of the renminbi.
Yeah, you mentioned some of the cuts we're seeing in the structural lending tools are targeted towards tech. We've seen that as the policy priorities, but you're still seeing an economy where investment is still very weak. You talk about consumption is still weak. The property market seems to reemerge, more risks. Where does that leave growth for 2026 now? Are we in for a deeper sort of slowdown?
I think net export will continue to be a positive contribution to the growth. Other than that, as indicated in the Central Economic Conference, they want to stop the decline of the investment. That's very important. Domestic demand is not only consumption. Investment is still very important. Of course, I think it seems that the government is allow the property market adjustment to run its course. But in terms of infrastructure investment and the manufacturing investment, this year is the first year of the 5-year plan. There will be a lot of key projects to be launched, and the budget resources, as indicated in the planning meeting, will be more directed to those areas. And also they are trying to boost the confidence of the private sector to also, I think, to increase investment. So we think investment is likely to turn around this year and supported by other measures to support consumption. But consumption is a slow-moving variable. I think, and also if we look at the trading program, I don't think they will expand it further, but they may broaden the trading program to include, for example, service. So I think that is a more longer-term game for consumption, to increase the consumption ratio in the GDP.
Part of the calculation among private companies in terms of the private investment and capex number is really where inflation goes. What are your expectations on price levels this year?
The price level, definitely the policy tone has changed. They want to see a moderate rise of the price level, and we can look at what target they will set. Maybe they will set again at 2% for this year, but it's very difficult to reach 2%, but at least it's a signal. They want higher price right now. And our expectation is a moderate rise of price. We forecast average CPI at 0.6%, higher than 0 last year in 2025. And this is kind of supported by quite a stable core inflation in China right now. So 1.2% for 3 months already. And the commodity price, even though it may not rise, but most likely it will become more stable. That would reduce one of the drag of the CPI inflation. So low inflation is likely to continue, and that is actually another reason why China's products is getting more competitive globally, because China have low inflation, the rest of the world is still inflation. So every year, China, I think, even on the price side, will become more competitive.
Ding Shuang, thank you so much. Very nice to speak with you. Let's do this again very, very soon. Ding Shuang, their chief economist for Greater China and North Asia at Standard Chartered Bank. The fixer today is coming out on your screens. Again, still above, but inching ever so close to that 7 handle, 70078 against the US dollar is today's midpoint. Okay, we'll take a short break. We'll be back shortly.
Well, the American Chamber of Commerce in China is saying that U.S. companies doing business there are actually showing some resilience amid a challenging economic landscape. That is the latest survey that's found that more than half were actually profitable across 2025. Now, almost 4 in 5 were also positive or neutral on relations with the U.S. This, of course, as we did see last year, that U.S.-China trade truce that continues on here today. But obviously, with news of late here with Venezuela, Iran, you got to wonder how the geopolitics plays into that.
I'm confused.
And whether these two leaders are going to really meet 4 times a year, which is what is still expected here.
Yes, that's
here
right.
to tell us a bit more about what the business landscape looks like here is AmCham China Chairman James Zimmerman. He joins us from Beijing. He's also a lawyer at Loeb & Loeb, which provides legal services to Bloomberg LP. James, it's great to have you on the program. Just tell us more about the key takeaways you think you got on the resilience that you are seeing on the ground there for business.
Very good. Thank you for the opportunity. We've been running this survey for about 30 years now, just to get an idea of the sentiment of our members and the things that impact them, the challenges and the growth opportunities and so forth. This year, we clearly can see that one of the key words that reflects the survey is that companies are indeed showing resilience. Resilience in a way that, I mean, they've come to the market, they've invested in the market, they've evolved, they've strategized, but they're not leaving. They're making money. And the results this year demonstrates that there has been an uptick in profitability, but there's also some challenges that they, need to address. One of the challenges, of course, is the softening economy, the concerns about the weakening economy, but also, too, is any potential for rising tension between the U.S. and China. That does impact, our member companies. So, but overall, resilience is really going to lead to opportunity in profitability. And part of that is because, you focus on where our companies do best. And they're strategizing and looking at how that they can capture some market share, how they can, tap the growing consumer market. So, but at the same time, it's really very, very important. The messaging that comes out of our report is that we need greater clarity, greater predictability, and some guardrails, in the relationship, because we want to avoid any kind of risk of further escalation. And it's not just because the U.S. is the first and second largest economies in the world, and it's important for the bilateral relationship, but it's also important for the global economy as well.
James, David here, thanks for joining us. I actually thank you for bringing that up, because I do want to get your thoughts on that. Since the trade truce back in November, and you mentioned things have improved on sentiment, how has the tone of conversations between the chamber or the members of the chamber with regulators, how has that tone improved?
Well, I mean, the survey actually was conducted about the same time as the meeting in South Korea when the two leaders met. And so that does have an impact on, the sentiment of where we're going for this coming year. But I think overall, it's a sense of optimism, because we're looking at presidential summits taking place in April and possibly in November. And that leads to greater dialogues, maybe a sustained dialogue to try to work through some of the issues between the two countries, the two economies. So there is clearly a sense of optimism, and that's reflected by the meeting that took place, but also the intents of both sides to try to tone down, some of the tit for tat that took place earlier last year, and to really focus on trying to resolve our differences and coming up with ways, that the two economies can work together. Because working together will benefit both sides, benefit the consumers, the companies, the growers, and everyone, workers as well, on both sides.
Yeah, James, reading the report, it's interesting. The concerns that might dominate the outlook is the competition you're seeing domestically with local players, right? We've seen that when it comes to some of these price wars in some key industries. How do you think companies how have they been navigating that? And have you actually seen this competition intensify, or do you think it actually has seen some easing in that front?
I mean, we'll always have local competition. And so I don't think our members are overly concerned about that. It is indeed a challenge, but they also meet that challenge by adopting to the market and selecting products, services that actually will bring results. Yes, there's going to be local competition on many levels, but that could be also a good thing too, because the messaging to us is that yes, our companies do need to adapt to the market. What we really want is to make sure the playing field is level, between domestic companies and China and foreign companies. A level playing field will ensure that we have a fair shake, a fair shake in competing, on the same level as the domestic companies. So local competition is there, but at the same time, we want to press ahead with policymakers on both sides, in that we want a level playing field. We want market access. And that's something that actually will benefit both the Chinese companies as well as the foreign companies if we do have an environment of fair competition.
And it's a good point you mentioned that, despite the outlook, they're still, these companies are staying, they're not leaving China. But have they started to at least rethink their presence in China? We've seen that with global companies like Starbucks, for example, selling their Chinese assets, or at least the stakes there. Do you think that's going to be that new business model really now to operate in China?
I mean, you have to look at things from the past, say 20, maybe even 10 years. It's where the market's evolving, and there's, companies are confronted with a variety of issues. There was a lot of calls for decoupling, de-risking, but we're not seeing a wholesale departure. Anyone that's leaving the market, it may have been a strategy issue that they've talked about, for some time, and it could be cost related. There could be a lot of issues that lead to anyone shifting their either the supply chains or where they are in the market. You give the example of Starbucks. I can't comment specifically on that, but there are companies that are making what we would consider to be very smart moves. Where for example, they're here in the market. Their brand is strong, but there's a lot of local competition, and the strategy of having others come in and finance growth, it does make some sense. So, but overall, I think what we're seeing is that companies are looking at the market as one of the top priority markets for them, but they're looking at having to strategize on their presence here and where their niche markets are, and that's not just in consumer goods or services, but across the board. Our members are looking at where they fit in best in the China market.
James, have a great weekend ahead. Thank you for taking the time to speak with us today. James Zimmerman there, chairman of AmCham China, joining us out of Beijing with the latest survey coming out of the group there. Going into the final session of the week, just over 3 minutes to the opening bell, up arrow story there is what we're tracking. Apart from that, lots of other things to watch. You have Trip.com, you have BYD, among other specific names we're tracking. Couple of placements to tell you about on the other side of this break, the opening bell, is coming up next. Good morning. Happy Friday morning from the Asia Pacific. Going into the opening bell today, a couple of things. One is the PBOC midpoint, the fix of the day, just above the 7 handle. You had, of course, an announcement of a coming rate cut on a structural relending rate that's effective on Monday. Does that open the room for further easing, or is that what we get for now? We are looking at an upside story. There's also separately the TSMC story, which is the tech story that's also playing out across these markets.
Could be some strong tailwinds there, really, those two forces, as you say, right? So maybe leaning towards more stimulus for the PBOC, and then, of course, this AI cycle that still seems to be quite strong here, given what the outlook from TSMC here, when you're talking about spending north of $50 billion in 2026 in terms of CapEx. And they're already seen as the most disciplined in terms of how they allocate their capital. So certainly bullish signals there, and you are seeing, as we are wrapping up this trading week, of record turnover, record margin financing. It seems like we're still firing pretty strongly here, and we are up about 0.6% for your CSI 300. We're watching very closely the chip space, and so Capricorn Tech is slightly higher here. So following some of the tailwinds that we saw from TSMC, and of course that US and Taiwan trade deal that has been at least agreed upon, right, with tariffs effectively now lower up to 15%. So that's how the AI situation is going here today. Let's take a look at how Hong Kong is faring. It's interesting, too, the PBOC, when it came to how they've looked at the currency, too, in that briefing, it seems like there was a bit of a change in tone, right? They said that, a lot of it had to do with the dollar weakness of late here. And so Goldman Sachs is saying this tolerance seems to suggest that they are willing to allow further appreciation of the currency here. So that supports their forecast of 685 for dollar onshore renminbi by year end. We're trading around that 696 level here. The fix today was maybe you could say slightly on the weaker side here, but it certainly wasn't what estimates were, which was something that was sub 7. There you go. But the tech sector is firing, right? HS Tech is up some 1%. You are seeing some pretty punchy gains on Alibaba and the like. Chip stocks are doing this. So SMIC, Hua Hong, the local players also doing quite well. ASMPT also up close to 5% here on the back of those TSMC earnings. And certainly, I think what we heard was that they really did try to at least allay some of the concerns in the industry, right? Whether that memory chip shortage might not be an issue, according to the CEO, when it comes to high-end products as well. And really those, the potential power constraints when it comes to AI data center build-out, those are not real, according to TSMC. So that certainly is helping that sector here this morning. We're watching, of course, some key ones when it comes to Wuxi Bio, Yuran Dairy, Unisound, all when it comes to announcing placements here today. So there you go.
The not so popular distant cousin of the IPO fundraising story is still a secondary placement market that seems to the I think was it Julie Andrews, Sound of Music, Alive and Well? The hills are alive with the sound of music. Yes. There we go.
Alive and Well. That's not a song.
That's not a song, right? I'm making things up. It's Friday, and it's going to get very cold next week, so just bear with us while our brain synapses don't fire as quickly. That's real, by the way. Check the weather forecast. Speaking of hotter and cooler, these markets, Winnie Wu is here with us, head of APAC Equity Strategy at BofA Global Research. Good morning. Happy New Year.
Happy New Year.
Nice to see you. Before we talk about, I know you just returned from a trip. I just want to ask you about your assessment. The start of the year, and they came out, they raised the margin, the margin ratio. Were there signs to you that the market was slightly overheated at the start of this year?
In fact, in our year-ahead strategy, we did say risk on for first quarter. I think this year, the performance of the market, for China market, could be more front-loaded. The start year is very strong, partly because, we discussed the liquidity factors such as insurance, jumpstart sales, and insurers need to allocate their premium into the domestic Asia equity market. I think there are expectations of, the better U.S.-China relationship, given President Xi and Trump is going to meet potentially a few times this year. And then there's the March 2 sessions. This is the first year of the 15th five-year 5-year plan, so there could be big infrastructure project or big plans being announced. So I think and of course, the optimism on global AI is coming back, and China technology innovation, that is a very structural theme. So I think this year, at the beginning of the year, we did see a lot of excitement and a lot of share price movement, but we do want to give a bit words of caution that, this year could remain to be a quite volatile year. We need to be mindful of the rotations. So for the full year perspective, we still say barbell strategy, right? So when some of the growth beta names gone very far, be careful of the rotation and corrections. Yeah.
So what's sort of the recommendation that you're seeing? I mean, you just came back from the US. I'm just wondering, the long only, the hedge funds, are they willing to chase this rally now?
Interestingly, I think Asia investors are more bullish on the Asia market, and China is one of the favored market within this region, right? I think the focus is very much Korea is the top pick within the region, followed by Japan and China. This is actually the feedback from our CIO conference yesterday. Bank of America just held our CIO conference, so we spoke to a lot of investors here in Hong Kong. But over in US, where I've spent like 10 days for meeting investors in New York, Boston, Miami, I think the positioning on China over there is actually quite light. Right, the hedge fund, the tourist monies are not focusing on China. Right, there are easier places for them to deploy capital, whether it's Brazil, LATAM, or Korea memory cycle, or the domestic US AI story. So I think the positioning in US is low, which fundamentally is actually good news that there's more upside for global capital to increase allocation in China.
The position in China, you mean? I think you mentioned
yes,
okay,
in China.
Okay. I think my question now is, when you have a global bull market where almost everything's doing well, do you think they're underweight China as a function of negative news in China, or is that because there's better stories elsewhere?
Okay. This is actually something I published yesterday. I wrote because initially it was a bit puzzling to me, right? Like why aren't the American investors more bullish on China? And I find out after meeting with many of them, the reason is one is there are easier trades elsewhere, right? And I think in the beginning of the year, we have seen some rebound in concern on geopolitical tensions after what happened in Venezuela, right? But more fundamentally is because in China last year, we saw stock price being volatile because the themes rotate very fast. So if you're sitting far away as an overseas investor, you might be late to a theme. And when you buy, it might be the final 10, 20%, and then you face a 30% correction. But given the scar effect in the previous year's down cycle, now many overseas investors don't have the conviction to hold through and wait for the next round of rally. So they might have bought late and sold too early before the next rally came.
Oh, no.
And the second problem is, in China now, the market leaders, a lot of them are new and familiar to overseas investors. We talk about AI technology and infrastructure names, talking about humanoid robot and component supplier, innovative drugs. All those are quite new themes. And many, especially I think American investors, they lost their China analysts over the downturn, and now they don't have the talent, they don't have the bandwidth to follow and track these new themes. So many of their position remains to be in the large cap, internet, consumer, EV, those names, which is still too much dragged down by the broader macro themes of price war, overcapacity, weak consumption. And finally, the third factor is, many of the new leaders are Asia companies, right? The industrial, the technology, with relatively poor English disclosure. And some of the, especially technology companies, they are reluctant to talking to American investors. They don't want to get on the sanction list. So the disclosure, the communication remains to be a gap. So there are, other than easier money elsewhere, geopolitical tensions, there are really these other constraints which is holding back some of the overseas investors. But I think there are again, these are potential upside, right? Especially,
it's a good problem to have if you think about it.
Exactly. And from a long-term perspective, I do think the long-term investors start to rebuild their China resources. I did some teaching on China market, even China banks on this trip. And I think people are exploring, like basket, right? If they can't follow the single stock A-share names, maybe it's easier to buy a thematic basket like we offer, China Innovation Basket, China Humanoid Robot Basket. And I think also these new IPOs is a great opportunity. Right, because now the C-level management, the CEOs now are willing to or need to speak to global investors. They are willing to tell their story and provide better disclosure, bridge the information gap. So I think these IPOs happening is really important and interesting.
All right, Winnie, thank you for joining us here. Winnie Wu, their head of APAC Equity Strategy of BofA Global Research. So this is a scoop that we have just broke here on your terminal. So China is clamping down when it comes to high-speed traders and removing data servers. So those servers are dedicated to high-frequency traders out of local exchanges data centers. That's according to our sources.
Right.
And they will affect high-frequency firms, so including global firms like Citadel, Jane Street, Jump Trading, and threaten their speed advantage. So what else are you seeing here right now?
Maybe just to clarify, what looks to be based on the scoop, the asset class that's come up to me so far is in commodity markets. I think that's an important qualification here. So qualifier. So commodities futures exchanges in Shanghai and in Guangzhou are among those that have. Can we get a commodities board up, please? Not this one. Have ordered local brokers to shift servers for their clients out of data centers run by the exchanges. That's according to people familiar with what's going on. I know there's a lot of piping conversations here. I think we'll clarify and finesse some of the details that's come through out of this Bloomberg scoop that's come in so far. But yes, certainly something to keep an eye on going forward. Okay, coming up. Why not talk about US Taiwan, the trade deal, and then you have TSMC, the story there. So the trade pact, cutting tariffs, boosting chip investments, what that means for the US and America's exercise to boost its semiconductor capacity domestically. All that is just ahead. TSMC on your screens, 1.5% to the upside. This is the China Show.
All right, we are just tracking, of course, the latest when it comes to this U.S.-Taiwan trade deal. So some lines that are crossing from the Taiwanese side here right now. They said they are going to be signing that trade deal in the coming weeks. And also they're going to expand, U.S. to expand investments in Taiwan as well. So, of course, we had that pledge of the Taiwanese and their American investments. Looks like it could be happening both ways. Taiwan also to announce market access and that card tariff after that deal signing. So that's the latest when we hear on this deal. But we talked about, lowering those tariffs on goods from the island to 15% and really putting it along the same lines as economies like Korea, like Japan. Also, chip companies in Taiwan increasing, of course, their financing for their U.S. operations. Bloomberg Economics sees the agreement having a modest impact when it comes to its economy, but says it represents an important political development. Let's bring in Michael Dang, geoeconomics technology analyst. He joins us now. Michael, it's great to have you on the program. What do you think this deal means for Taiwan, and why are semiconductors at the center of it?
Yeah, so, Taiwan really spent a lot of last year struggling to finalize that trade deal with the U.S., seeing the trade deal go across the finish line for Korea and Japan. And the concern there was that, we've seen improved U.S.-China relations late last year, given the détente we saw there. There's also Trump's expected Beijing trip to April coming up. And so the fear was if this didn't go through, it could have left them sidelined. So now that the deal has gone through, and then you take that along with the arms deal that we saw last month, it really sends a signal that the U.S. Is still supporting Taiwan, still invested in this relationship. And semiconductors are at the heart of this because they're the biggest Taiwanese export to the U.S. Chips up until now have been exempt from Trump's tariffs, but there was a lot of lack of clarity around, how long that exemption would hold. We knew for a while that there were Section 232 tariffs coming on semiconductors, and there was a vague exemption mechanism that was talked about here or there. So the important thing here is we finally get clarity around around the concrete mechanism that the U.S. is going to use to exempt most semiconductors from the tariff impact. And for such an important product, it's very good to have that clarity finally.
Yeah, and Michael, David here, thank you for joining us. So it's sometimes very difficult to figure out when we have these trade deals that take so long to negotiate and finally we're here. What in the fine print is actually new? And I think this $500 billion headline in terms of sort of both direct investment and credit guarantees, how much of that is actually new? And broadly, how does it fit into the broader strategy?
Yeah, so it's interesting. Of that $500 billion that was announced, right, we've already seen reports say that the $165 billion that TSMC has already committed out of the 250 half that's the direct investment, that's included in there. So it's not all new investment. It's still sizable, whatever's left over, and you could see lots of room. They've discussed that part of that could be the additional 4 fabs that have been reported as part of that investment. The other half of that is the $250 billion that's a softer commitment of credit guarantees. It's a soft commitment, but I think that there's plenty of use there as well, especially for a lot of these small and medium Taiwanese businesses that are going to need to be set up in Arizona to support that ecosystem that's developing there, especially if TSMC makes good on all of the investments that it's announced so far.
And we heard from the Commerce Secretary, Howard Lutnick. He said the goal is really to have 40% of Taiwan's supply chain or semiconductor supply chain in the U.S. Does that look reasonable to you or realistic at all?
It's definitely ambitious. I'll say that. It's not impossible over, let's say, the next decade. So before this deal, the rough idea was maybe 30% of TSMC's most advanced capacity, so 2 nanometer and better, would be in Arizona. But that's assuming like all the construction projects announced before this current deal was finished. So we now know there's going to be probably 4 new additional fabs there. And TSMC's capacity isn't all of the semiconductor supply chain, but it's most of it, right? And so you can kind of squint and see how you get there. So it's possible, but again, advanced fabs are hugely expensive. They take years to build. TSMC has still spoken about the permitting issues that they have there, though. That has improved over the last year. But workforce, supply chain infrastructure, it's not out of the question. But it's not going to happen quickly.
Michael, fantastic. Thank you so much. Great insights, and really the nuance is what's key there. Michael Deng, Bloomberg Economics, geoeconomics tech analyst. In fact, when you look at TSMC and the big number that's coming up, this is the projection from analysts. It's really what part of TSMC's revenue is really at the very, very high end, 3 nanometer and below, and what part of that capacity separately will actually go into the United States as far as advanced chip manufacturing is concerned. But yes, earnings were out, CapEx guidance was out, signaling confidence in the longevity here of the global AI boom. Now, the CFO, Wang, spoke with us about that expansion in Taiwan and also in the United States.
It really depends on customer demand. In the U.S., a lot of customer wants to go there, so we will expand over there. But for the leading edge technologies, it will be in Taiwan because it's a heavy cooperation between the R&D people and operation people for practical reasons.
And leading edge will continue to be led by Taiwan, you think, over the US market, and that no changes to that at all, even with you adding a lot more capacity in the States?
Yeah, that's for practical reasons.
Is it possible, though, to speed up how quickly that advanced tech can be shifted from Taiwan to the States?
Yeah, we can try to do that, to shorten the gap.
What does that transfer gap look like then? If right now it's several years, Taiwan is ahead, what does that actually look like in the future?
We don't have a specific timeline now, but we can try to accelerate that. We think we can try to accelerate.
Could it be shortened to months, do you think?
It will be difficult, challenging.
Okay, so it stays at least one year behind then. CapEx, it's $52 to $56 billion.
For this year.
Yeah, for this year. So can you tell us exactly how much of that is going to the US, given you've got such a big focus on the capacity build out there?
We don't just break down those numbers, but we do tell people that in the next 3 years, the total CAPEX is going to be significantly higher than the number in the past 3 years. So that is evidence of our strong conviction in the AI megatrend.
Our sources are saying, for instance, at least 4 additional fabs could be added in the US in addition to what's already been pledged. Is that realistic?
It depends on customers' demand. We are looking at very strong customer demand.
Could you give us a number?
We don't have the number now.
Do you want to ask about Intel as well? I'm wondering whether you see any potential for collaboration with the business, given they've got very strong expertise in advanced packaging technology in particular. Could that be an area for you to work on, given you're already outsourcing this to third parties with your constraints?
It depends if it makes sense to the customers and also if it makes sense to our wafer business. The advanced packaging business to us is a strategic. It enables our wafer business. So if there are more alternatives in the market which can enable our business, we can consider that.
Would you weigh up investing in Intel just like some of your biggest customers have done?
No discussion at all. All I'm trying to say is it can be considered.
Taiwanese dollar, in our survey of different FX strategists and analysts at Bloomberg, they're actually saying it's going to end the year at 30.9. So what is the impact to you if you see that further sort of strengthening, and what sort of headwind does it represent?
Foreign exchange rate between US dollar and NT does affect our profitability. In the past, for every percentage change in foreign exchange rate, it will affect our margins, gross margins and operating margin by 40 basis points. Nowadays, when the margins are higher, the impact become less sensitive. So nowadays, it's about 30 basis points, either way.
And how are you looking at hedging strategies as well?
The easiest way is to sell US dollar into NT. However, the market impact should be considered. If we're not able to sell all these, then we will do the forward contract. And if we still cannot accommodate all the positions, then we will continue to do moving the US dollar to the offshore entity, which has US dollar as its functional currency.
That was TSMC SVP and CFO Wendell Huang speaking with Bell in Taipei. And if you are a subscriber and want to rewatch that interview, you can watch through our interactive TV function. Just check it out at TV Go.
All right, we're just going to go through some of these movers. BYD 2% to the upside. That's number one. Number two is Trip.com, and we'll spend more time on this in the next hour, certainly given the investigations there around the company, which the company said they are, of course, going to cooperate with investors. Shares are up slightly today. I think it was Yuanta Securities that's come out with a buy rating on the stock there. And of course, coming up in the next hour, Morningstar will be joining us as well to talk us through their outlook and their assessment of what's happened given the investigation.
Welcome back to the China Show. Here's a look at the HSI half hour into the session. And we are seeing here a session, well, we're coming off some of the initial highs from the open there. Obviously, we were tracking what's been going on when it comes to the AI trade and the like here. But you are seeing, what's really kind of leading to sentiment to kind of sour a bit in the last few minutes.
Yeah, well, I think not so much the news flow, but the price moves in the last, 10 trading sessions that we roughly had so far, of course, for the year, right? So it doesn't really, I guess, to some extent matter how good the reporting was out of TSMC, just as an example, right? The fact that the shares have run up. And not to say, of course, over the longer term, because that's a different proposition when you look at 12-month targets. But, selling the news is probably something that you could attach to some of these markets right now. In fact, I think TSMC last we checked was up 4.5 overnight, was up 2.5 at the open. Can we show TSMC, please, just to get a sense? And I imagine that's come off a little bit off the highs of the day. Taiwan is up 1.1. Flip the page, please, just to get a sense of what TSMC is doing in other chip plays. SMIC, Huahong Semi could be a separate story. But yeah, there we go. See, we are coming off highs of the day on TSMC. But all that is to say, this is a longer-term story, of course, in the AI trade. Joining us now to talk us through the state of these markets going into the weekend and quite a really good 2 weeks we've had so far in 2026. Abhishek Vishnoi, our senior equities reporter, joins us out of Singapore. Abhishek, let's talk about this Bloomberg scoop in a moment on China and data centers and what have you, and brokers and what they're doing, being asked to do. But what's the sentiment right now across markets today? What's your team talking about?
Well, it's pretty much, how 2025 was. TSMC results have made sure that AI remains the core equity trade. And the rotation that everybody was thinking about just a few sessions ago, that gets put on the back burner. So, in case of Asia setup, China, Korea, Taiwan, they remain the darlings. Markets like India would continue to underperform, even if on the absolute level there may be some gains. The results and the confidence by TSMC's management, given their guidance and CAGR guidance for the next few years, shows that even the consensus earning estimates are sort of underpricing AI being, not cyclical but a structural change. Like we have seen comparisons with Industrial Revolution and things like that. So those estimates are getting revised upwards. I think TSMC itself has gotten upgrades of 7 to 8% by a couple of brokers, including Morgan Stanley. And that should flow in the entire gamut of supply chain, especially in Japan, semiconductor equipment plays, chip testers in Malaysia as well, and TSMC's peers, across the globe. So that remains pretty much the setup. And on the other side, we have got this, somewhat of a clouds coming on China because the regulators, the government want a slower bull market there. So in addition to, some slowing macro data, some, not so great margin financing moves, we have now gotten this, clamp down on HFTs that you're talking about.
Yeah, and there was this scoop that we just had about regulators clamping down on these high-speed traders and removing data centers, or servers, I should say. Can you tell us what this all means and what impact it could have on the market?
So, we are seeing somewhat of an impact on the market. If you see, China started higher. Now, it has given up gains across indexes, even in Hong Kong. But, this is nothing dissimilar to what's happening in the rest of the world. You got to understand that, high-frequency traders, big firms, they do get muscle, they do get a lot more power as they're very close to exchanges. And if you're operating, your servers are operating from data centers of exchanges, you are in the heart of stock exchange. That gives you time advantage. All these exchanges and futures commissions are doing is creating a level playing field, because they now realize that these companies might be having a little too much unfair advantage, which puts local and other investors at a disadvantage. Now, what we understand from our scoop is that this high frequency traders have been told to remove their servers from local stock exchanges, data centers. They would largely impact these kind of traders, institutional traders within China, and also firms like Jane Street, Jump Trading, etc. The plans are that people familiar with the matter have told us that exchanges are planning to preliminarily add a couple of milliseconds to the latency of any servers, and this should help. We are seeing the market, giving up its gains right now. But look, a similar thing happened in India, similar thing happened in the US, but markets are at record highs, at both the places. Whether India is underperforming right now is immaterial. So keep this context in mind. These things happen. These are, market structure changes which are required. But if there is money to be made, any kind of investor, institutional or retail, will find a way to make that money. And China remains in great spot. Despite the macro issues, China is not a macro trade right now. It's a trade on AI. It's a trade on technology, innovation, and that would keep it, in pretty strong hands. So any great dip, from on back of this move, this clamp down, as we are calling it, would be a buy on dip opportunity, as some investors have told me.
Abhishek, fantastic. Thank you. Abhishek Vishnoi there, our senior Asia equities reporter, Right, just to pivot to one of the stories we touched on there with Abhishek, of course, which is the Taiwan and TSMC story, and more broadly, of course, on the trade pact here. So the two sides have agreed, the US and Taiwan, on a trade pact to lower tariffs on goods from the island to 15%. Now, in return, you have Taiwanese semiconductor companies will increase financing for their American operations by $500 billion. Now, that includes at least $250 billion in direct investments to expand semiconductor, energy, and AI facilities.
Yeah, and TSMC says it will try to speed up the transfer of its advanced chip-making expertise to the U.S. while continuing to develop and maintain its top fabrication techniques at home. The CFO, Wang, telling us that even with faster transfers, it would still take at least a year for mass form production of its leading technology.
We don't look at it this way. It really depends on customer demand. In the U.S., a lot of customer wants to go there, so we will expand over there. But for the leading edge technologies, it will be in Taiwan because it's a heavy cooperation between the R&D people and operation people for practical reasons.
And leading edge will continue to be led by Taiwan, you think, over
Yes.
the US market, and that no changes to that at all, even with you adding a lot more capacity in the States?
Yeah, that's for practical reasons.
Is it possible, though, to speed up how quickly that advanced tech can be shifted from Taiwan to the States?
Yeah, we can try to do that, to shorten the gap.
What does that transfer gap look like then? If right now it's several years, Taiwan is ahead, what does that actually look like in the future?
We don't have a specific timeline now, but we can try to accelerate that. We think we can try to accelerate.
Could it be shortened to months, do you think?
It will be difficult, challenging.
Okay, so it stays at least one year behind then.
That was Bell with the CFO of TSMC, Wang, just very recently, of course, post the company's earnings. Right, just ahead from tech and IT and AI, we'll pivot and have a look at Chinese biotech, another hot sector. Akeso CFO Wang will be joining us at the JP Morgan Healthcare Conference. A lot of headlines, a lot of deals from this week there. We'll talk about drug innovations, deal making, and of course, they do have one specific one that the market's very attuned to at this point in time. So we'll see what we can find out of Akeso in a moment. That exclusive interview is just ahead.
Well, it is Friday, and the last day of the healthcare sector's marquee event, the JP Morgan Summit in San Francisco. We've been getting plenty of market-moving announcements and really kind of great guests, really, the whole week here on the China Show, and really including news from Chinese firm Akeso that its U.S. partner Summit Therapeutics is seeking FDA approval for combination use of a cancer medication, which last year helped thrust China's biotech sector into the global arena.
Yep, joining us exclusively is Akeso CFO Wang to talk us through this specific drug in the pipeline and many others that they have in store, plus industry trends. Wang, good morning from the Asia Pacific, and we appreciate your time. If we could start on this one specifically, ivonescimab. The market just wants to figure out what probability they attach to this getting approved by the FDA. What are your thoughts on that?
Well, obviously, I can't predict the future, but based on all the data that we generated in China, as well as the fact that over 60,000 patients in China in real-world setting have already used this and have consistent profile with our, I would say, 4 phase 3 study, all successful phase 3 study with great efficacy and safety. I think the chances are pretty good. So, from everything that we've seen so far, we feel pretty good.
There are still some concerns among investors about some of the results that came out from this late-stage study here, reported by Summit, that it perhaps didn't provide enough definitive results that did meet FDA requirements. How do you begin to even address those concerns, or have you already?
Sure. I think some of the conversations, obviously, Summit has with the FDA. But from our perspective, if you actually look at the trend of the data that Summit has generated, it's been consistent with everything that we generated in China. So that's the first piece. I think the second piece, again, I think if you look at the data package holistically and the fact that we have multiple data generated that show consistent safety and efficacy from the Chinese data, and that actually telegraphs pretty well in the U.S. data. So overall, I think the Summit team has done a fantastic job in developing this product and addressing some of those concerns. But again, we're going to have to see how the FDA decides later this year.
Right. Some of your peers in the industry have also looked specifically at this area, and I wonder if and when, let's just say when, of course, to the point you're making, all the data points that's getting through. Is differentiation even a concern for you at this point in time, or is the pool and potential large enough for everybody at this point?
Well, I mean, there are two separate questions. So the second part of the question, which is the pool is quite large, right? I think top-tier analysts have estimated this to be close to $100 billion potentially. But from our perspective, it's hard for us to answer that question because between us and Summit, we actually have really successful phase 3 studies. We have 4 phase 3 studies that show consistent efficacy and safety across the board. The rest of the world combined have 0 phase 3 study. So it's hard for us to make that comparison because we actually have 4 versus 0 for the rest of the world. And the other point we want to highlight is that bispecific antibodies, which is a class of drug that we're working on, the differences between bispecifics hitting the same 2 targets are actually much greater than single target monoclonal antibodies. So while single target hitting PD1, PD1A versus PD1B, the differences between bispecific is much greater than single target. So the fact that we went through and done 4 phase 3 study showing consistent efficacy and safety profile in basically thousands of patients, the burden of proof is on everybody else to hit that level of efficacy and safety. So right now it's hard for me to answer the question because there's really no real benchmark.
So it sounds like
I think
you're pretty confident, right? Are you pretty confident?
I feel pretty good. I sleep very well.
So we'll maintain that lead. Yeah. Bing, I was going to ask you about obviously your main focus has been on cancer treatments, but certainly you also have diversified in other areas, right? Autoimmune diseases, for example, more recently Alzheimer's. Can you tell us a bit more of the rationale of going into these diseases in particular?
Yeah, great question. So I think over the past few years, we really established our, I would say, global leading capabilities in bispecific antibodies in immuno-oncology. So we took that capability and went into adjacent areas. So one of them is a class of drug called antibody-drug conjugates. So we actually have 2 of those in phase 1 study in Australia and China right now. One of those it's a bispecific antibody-drug conjugate hitting 2 targets, TROP2, Nectin-4, at the same time. So by hitting 2 targets in ADCs, you actually reduces the chance of tumor escape. So our goal is actually to combine that bispecific ADC with our bispecific IO agents to hit 4 targets with 2 drugs. Now, you mentioned other therapeutic areas outside of oncology. We also have a first-in-class immunology asset that hit a target called IL-4R and SC2 at the same time. Again, we just want to give a broader spectrum of suppression of some of the drivers for immunological disease, such as COPD and asthma, and potentially atopic dermatitis at some point. But one of the most exciting announcements we had roughly about 2 months ago, to your point, is Alzheimer's. We're very excited by this. So we hit 2 targets. One is a beta amyloid. So as you may know, amyloid plaque is a big driver of Alzheimer's. But the issue with current beta amyloid antibodies is that it has trouble getting across the blood-brain barrier. So roughly 1% of the drug actually gets into the brain. So they have to give patients really high dose and cause a lot of side effects. So what we did is we added a second target in our bispecific. It's a brain shuttle program that basically allows the therapy to cross the blood-brain barrier in a much more efficient manner. So the goal is then you don't have to give the patients many drugs. A lot more drug actually hit the beta amyloid in the brain and have a better chance of actually helping patients to, basically to treat Alzheimer's in these patients. So we're very excited by this. This is one of the most advanced programs in the world in this in this setting. So we're very, very excited by this molecule.
Yeah, and so if you could be maybe more specific. So you have 26 candidates, correct me if I'm wrong on the actual figure. 26 candidates have entered clinical trials. Of the 26, which ones specifically, if any, are in the Alzheimer's direction, if any? If you could give us a timetable too, if at all.
Yeah, so we have one program that we announced in November that have entered into clinical study for Alzheimer's. So that's AK152, and that's a bispecific targeting beta amyloid and a brain shuttle receptor.
Okay, understood. And so that's one of the 20. That's one of the 26. Could you give us maybe more? Because I think you have 7 that are now commercially available. Could you give us a timeline maybe of the 25, the other 20, not all 25, but just give us a sense of what to expect this year?
Sure. We have a lot of potential update for this year for 2026. I think a lot of folks are focused on potential data updates and regulatory updates for ivonescimab. This is our PD-1 VEGF bispecific that we partner with Summit. So potential approval for for Summit side in the U.S. Something that I think we're very excited about, as well as additional expansion of indication for ivonescimab in China. So right now it is approved for second-line lung cancer for folks that have used a small molecule targeted drug called EGFR inhibitors for folks refractory from that. That's approved in China. It is also approved for first-line monotherapy for first-line non-small cell lung cancer. And so hopefully very soon we'll add on to additional indications within non-small cell lung cancer where you use it in combination with chemo. So there's multiple expansion of indications just for ivonescimab alone. And then our other bispecific for immuno-oncology is cadonilimab. This is both targets are actually immunotherapy, so that's PD-1, CTLA-4. We announced actually just a few months ago, we started 2 global registrational studies. So this product is approved in China, but in the past few months, we actually started 2 global registrational studies, one for second-line liver cancer and the other one for first-line gastric cancer. So these are global studies. With these approval, hopefully everybody around the world can benefit from cadonilimab. And then we have a number of earlier assets that we talked about earlier.
Yeah, big one. It's interesting. I still remember back in 2022 when this deal with Summit really kind of catapulted you guys and Chinese biotech sort of into the main stage over there at the conference. What are conversations like this time around in San Francisco? And are you out to be making any announcements here in terms of out licensing deals this year?
We're not going to obviously tip our hand there, but I think a lot of the conversation is, I think companies recognize not only are 2 bispecific, again, ivonescimab and cadonilimab, have really good efficacy, but they have very, very good safety profile. So this is key because we actually talked to quite a number of other companies, right, that want to take their drug and combine it with ours to do combination therapy. So this is where the efficacy, again, demonstrated across multiple phase 3 studies, is key, because if you think about other parties, right, they don't want negative data. So they actually want to partner with products that are very, very safe and potentially going to be a cornerstone, IO agents in the future. So some of our conversations around that, and you actually saw an announcement from Summit that they're going to partner ivonescimab with GSK's B7H3 antibody drug conjugate. So I think as people see that, our bispecific can potentially replace the current PD-1 treatment as anchor oncology treatments, we're going to see we have a lot of folks that want to take their drug and combine it with us and actually help them to take their product to the clinic as well. So basically, last year is about us running ahead of everybody else. Now this year is about everybody running fast together.
Which is a good thing. Which is a good thing. And this is not my journalist hat talking. This is me as a human talking. I wish you all the success, and hopefully, of course, you guys nail this for the world's benefit. Can I just ask you a final question as CFO? In terms of financing this year, how much debt or equity do you think you'll need? I just looking at your financial statements, and do you think you'll be profitable this year?
No, we're not giving any type of break-even guidance this year. We will continue to invest in our R&D. We have one of the most, I would say, efficient and actually highly productive R&D programs. So we're actually investing into our R&D like a biotech based in California or Boston. So we're going to continue to innovate. We have been very productive. So we're not giving any guidance on breaking even. So our P&L, right, our revenue and operating income is primarily come from China. But our R&D value is global in nature. So again, we're going to continue to invest in R&D, and we're not giving any guidance on break-even and P&L.
All right.
Message received.
We'll wait until the earnings.
Yeah.
Bing Wang, thank you so much, CFO at Akeso. And what a voice. if you don't want to do biotech, Bing Wang, let us know.
Yeah.
You can host
right
a podcast or even host a show on TV. Speaking of TV, you can watch, of course, this interview on TV Go or interactive function there. Make sure to check it out. This is Bloomberg.
All right. A decently big move in the Japanese currency, as you can see on dollar yen. So from 158.70, we're now pushing into the low 140s right now, 158.40s. Commentary coming out of the finance minister. Number one, they're concerned about the recent yen weakness. They have said time and again they're prepared to take bold action, and that there's an agreement with the U.S. Treasury sector, including intervention so far. But yes, more verbal pushback coming through here.
Yeah, I mean, I think we were close to even 160 overnight. And I think that was sort of the psychological level that most thought maybe that does spark some intervention, which was what we saw sort of last year. Yeah. So certainly that's going to be one thing to watch here. We are seeing maybe them amping up the verbal intervention, at least from the finance minister here this morning. We're also checking some stocks like JR East, for example, big moves that we saw earlier here. There was some outages or the like here, but we were hearing the Yamanote line to resume service around 1 p.m. local time.
Essentially, you try to ask say whether the AI demand is real or not. I'm also very nervous about it. You bet, because we have to invest about 52 to 56 billion US dollar for the capex, right? If we didn't do it carefully, and that would be a big disaster to TSMC for sure.
That was the CEO of TSMC there on the topic of AI demand, and of course following the company's earnings and the guidance, and analysts playing really some massive catch-up, bumping up the consensus price target on the stock by 7% from pre-release to post-release. As of this morning, that consensus target stands at about $21.50 on the stock itself. That's a 12-month horizon, of course. Joining us now to talk us through the company earnings is our Asia Tech correspondent, Annabelle, who is in Taipei for us, of course, to talk us through. And the conversation that you had, of course, with the CFO. Did anything actually stand among the many, many, many things we could talk about about TSMC here?
Yeah, well, I think just reflecting on what you heard from CC Wei there, it was that big focus, at least initially in the earnings conference, on the AI demand, because that was in response to a question from JP Morgan, actually, what CC Wei said there. But essentially they were saying that they've spoken not just to their customers, but their customers of customers as well. And that's why they're so confident about this huge CapEx investment that they're making, because between $52 to $56 billion this year, that's way past what we saw last year and well ahead as well of what we saw the year before that. So they're just saying essentially that they're continuing to ramp up investment, and that's also because they, again, see that demand is genuine and certainly played into the figures, because they're looking for sales growth, for instance, this year of around 30% or nearabouts in US dollar terms, and also looking for better margins as well. And this was a really interesting point, because gross profit margins, they're expecting to come in between 63 and 65%. That was ahead of analyst estimates at 59.6, but also their longer-term target, they raised this because they've stuck at 53% for such a long time. They actually felt comfortable enough to raise that to 56%, but it just speaks to their capacity utilization, how strong that is, and also that pricing power they have in the market as well. And that's enough to offset this huge investment, of course, that they're making in the States.
And TSMC, I mean, very much at the center of this trade deal with the US and Taiwan have agreed upon here. What was their sort of response to all that?
Yeah, exactly. I mean, it's been a pact that's been months in the making, essentially. And even though TSMC wasn't named specifically in the statement on this, we know, of course, that they're very much really the focus point of it in terms of what's being committed, because you're looking at a $500 billion in financing, essentially, so $250 billion in direct investments. That includes $100 billion that's already been pledged by TSMC, but also looking at a further $250 billion in credit guarantees for further investments in the American semiconductor supply chain. So I think that when you talk about TSMC, of course, I was really interested to try and get a sense of exactly how many fabs are you looking to add there, because we had reporting this week that they were looking at least 4 additional ones. They've just acquired a second site in Arizona. They've got already pledges in place for 6 fabs plus 2 advanced packaging facilities, 1 R&D facility as well. So a very big site that they're building out there. But in terms of the priority as well, I spoke with the CFO, Wang, about this. Which one is more important, Taiwan or the US, and which way do you think about it as well? But take a listen.
It really depends on customer demand. In the US, a lot of customer wants to go there, so we will expand over there. But for the leading edge technologies, it will be in Taiwan because it's a heavy cooperation between the R&D people and operation people for practical reasons.
And leading edge will continue to be led by Taiwan, you think, over the US market, and that no changes to that at all, even with you adding a lot more capacity in the States?
Yeah, that's for practical reasons.
Is it possible, though, to speed up how quickly that advanced tech can be shifted from Taiwan to the States?
Yeah, we can try to do that, to shorten the gap.
What does that transfer gap look like then? If right now it's several years, Taiwan is ahead, what does that actually look like in the future?
We don't have a specific timeline now, but we can try to accelerate that. We think we can try to accelerate.
Could it be shortened to months, do you think?
It will be difficult, challenging.
Okay, so it stays at least one year behind then. CapEx, it's $52 to $56 billion.
For this year.
Yeah, for this year. So can you tell us exactly how much of that is going to the US, given you've got such a big focus on the capacity build out there?
We don't just break down those numbers, but we do tell people that in the next 3 years, the total CapEx is going to be significantly higher than the number in the past 3 years. So that is evidence of our strong conviction in the AI megatrend.
Our sources are saying, for instance, at least 4 additional fabs could be added in the US, in addition to what's already been pledged. Is that realistic?
It depends on customers' demand. We are looking at very strong customer demand.
Could you give us a number?
We don't have the number now.
Do want to ask about Intel as well. I'm wondering whether you see any potential for collaboration with the business, given they've got very strong expertise in advanced packaging technology in particular. Could that be an area for you to work on, given you're already outsourcing this to third parties with your constraints?
It depends if it makes sense to the customers and also if it makes sense to our wafer business. The advanced packaging business to us is a strategic. It enables our wafer business. So if there are more alternatives in the market which can enable our business, we can consider that.
Would you weigh up investing in Intel just like some of your biggest customers have done?
No discussion at all. What I'm trying to say is it can be considered.
Taiwanese dollar, in our survey of different FX strategists and analysts at Bloomberg, they're actually saying it's going to end the year at 30.9. So what is the impact to you if you see that further sort of strengthening, and what sort of headwind does it represent?
Foreign exchange rate between US dollar and NT does affect our profitability. In the past, for every percentage change in foreign exchange rate, it will affect our margins, gross margins and operating margin by 40 basis points. Nowadays, when the margins are higher, the impact become less sensitive. So nowadays, it's about 30 basis points, either way.
And how are you looking at hedging strategies as well?
The easiest way is to sell US dollar into NT. However, the market impact should be considered. If we're not able to sell all these, then we will do the forward contract. And if we still cannot accommodate all the positions, then we will continue to do moving the US dollar to the offshore entity, which has US dollar as its functional currency.
Yeah, so the currency, of course, was quite a big headwind for the company last year when you had that biggest one-day move in the Taiwanese dollar in early May in 4 decades. But coming into this year, I think it's going to be very interesting to watch, just given that size of the commitment to the US in this new trade pact between Taipei and Washington. Perhaps you actually start to see the Taiwanese dollar come a little bit under pressure.
All right, Belle. Thank you, Annabelle Jewelers. Thanks so much, and great work there, of course, in Taipei. Coming up, we're going to talk a little more about Trip.com. Morningstar giving their outlook when it comes to the company as shares of China's largest online travel platform plunge as regulators launch an antitrust investigation.
Before we take a short break, just look at some live pictures, I believe, here out of Japan, of course, where you do have the Japanese government officials and, of course, the Italian Prime Minister in Tokyo there. Based on early reporting out of the Nikkei, Japan and Italy to agree on space development. And separately, the Yomiuri News is talking about how both are also set to agree on critical minerals cooperation. More on that and more. This is Bloomberg.
Tell you about all the diplomacy that's been happening here. What we're seeing with China and Canada pushing to expand energy deals with visiting Prime Minister Mark Carney, looking to sell more oil and gas, while also courting Chinese investment in batteries and renewables. And earlier, we spoke with the CEO of WPIC about access to critical minerals.
There have been restrictions on critical minerals. There's also been restrictions on chips headed into this market. I mean, which affects us and our data centers here too as well. But realistically, it might have increased costs in some of those areas, but we're not running into a lot of businesses that are having total maybe production shutdowns because they don't have access to what they need right now. And the same thing with all the last earnings in China too. They've said as well, they're getting access to the chips and compute that they need too. So, hopefully, governments see that and just start to remove these barriers from us.
Stephen Engel, our Chief North Asia correspondent, joins us from Shanghai. Steve, before we look ahead to the meeting with President Xi, just help us understand the significance of this framework agreement around energy between the two sides.
Yeah, I think it was quite interesting, obviously, because there's been a bit of a diplomatic chill over the last 8 years or so between Canada and China, especially over the last couple of years. We had back in 2018, of course, the arrest of the Huawei executive Meng Wanzhou. But then in the last couple of years under Prime Minister Justin Trudeau, you had Ottawa essentially putting some of their trade policies towards China in line with the United States and adding tariffs on Chinese steel and aluminum, as well as 100% tariffs on EVs. These are things that Xi Jinping and Li Qiang, who you see here walking in the Great Hall of the People with Mark Carney yesterday, would like to see Ottawa reduce, if not get rid of completely. Well, Canada also wants some changes as well, including allowing canola or rapeseed to drop those Chinese tariffs on those. But the big deal today is essentially announced after meeting not only with CATL, the big battery maker, but also the co-chairman of CNPC, which is the big national petroleum company, and also meeting with Li Qiang, is this framework pact between the two countries to cooperate on energy, whether it's renewable energies, whether it's crude oil, whether it's LNG. Chinese interests are already invested fairly heavily in that LNG Canada's export terminal in British Columbia, as well as oil sands in Alberta. But the Canadian delegation is showing some inclination that they might be willing to open that up as well. And again, there was even the industry minister, Melanie Joly, saying we're open for business when it comes to batteries. So there could be an opening here for CATL or other Chinese makers of EV batteries to come and build a factory in Canada. Again, that would raise some eyebrows and some concern in the Canadian auto and auto parts industry, not to mention Donald Trump to the south of the border. But again, Mark Carney clearly taking a more proactive approach in engaging China as an export market and also as an import destination of investment.
Yeah, and they're about to meet too, Carney as well as President Xi. What do you think is on tap for that dialogue today?
Well, I think those 100% tariffs on Chinese EVs will be discussed. Rapeseed or canola will be discussed. Oil purchases by China from Canada will be discussed, I'm sure, given the situation in Venezuela, where China essentially bought a lot of the sanctioned Venezuelan crude. Also, the tenuous situation in Iran, where China buys 90% of Iranian oil exports. That's also in a tenuous situation. So again, finding an alternative international source in the form of Canada might be very prudent for Xi Jinping. So still lots to discuss as the rapprochement continues.
Steve, thank you. Stephen Engel there, our chief North Asia correspondent, joining us out of Shanghai, of course, as we count down to that meeting between the two presidents, or prime minister and president. In terms of really what else to watch for next week, I mean, there's a lot going on, right? Dave, you talk about, the Australian Open, that kicks off this weekend as well, but Davos.
Not the market open, right? This is
tennis for
tennis, yes.
Davos, that's going to be the big one, of course, next week, given just all the big macro themes and really how geopolitics has really been front and center in just like the first few weeks of 2026. So certainly that's going to be of a topic here. We have, of course, a data dump for the fourth quarter, of course, GDP numbers out of China that are going to be happening next week. And of course, you can't forget the BOJ decision too, Dave, given the moves that we've seen in the yen.
Given the moves in the yen, given the backing up of
election
yields.
announcements.
Yes. Yeah. And so I wonder how they're going to frame that, because interesting to note from HSBC specifically, so Joey Chu, I think they've revised their yen forecast for the year, given the fact that some of the biggest factors that might lead to yen strength aren't imminent, right? Yeah. Whether that's a positive yield, real yield, and all those other things. I think it's interesting to see how the yen, market forces will keep the yen weak, but they will need to be more vigilant on the official side, of course, to keep market expectations not one-sided on this. And I think we've seen two episodes of that already this week, that they've come in with some very strong, not the strongest language possible, but some very clear language that they are ready and watching these moves very closely on the Japanese currency.
And if they're going to intervene, how effective is it going to be this time around when you have this prospect of fiscal stimulus that continue to drive up interest rates higher, but then it's not doing anything for the yen? And you continue to see this sort of weakness in the currency, and certainly that's going to be a key thing to watch here. Yep. So the yen just facing this kind of double whammy, as we've been calling it, with snap elections as well as the BOJ next week. That could be a key focus there as well. What else are we talking about? I feel cold now.
Yeah. Speaking of cold, snap elections.
You're telling me next week is going to be even colder?
Don't believe me. Look at two things. Look at the forecasts for next week. And so the reason we're looking at this, we actually have a fantastic piece. Shout out to our colleague, Mary Hui, who's actually put this together, because this does have a commodities angle to it, right? So we could actually see some of the record lows, not in markets, but in weather, get tested as this
what's Beijing again?
Cold, I think it's
negative 20?
Expected to be negative 17.
Yikes!
Next week, which is way below the 30-day average. And Hong Kong as well is going to be part of that cool conversation next week.
All right, we're checking trip.com here this morning, and really the last 3 days, it certainly has seen the stock collapse in some ways on the back of this antitrust probe. And right now we're seeing that Chinese regulators are looking into the online travel platform over antitrust concerns. Now, Trip says it's cooperating with investigations, but Morningstar thinks it could now face the same kinds of headwinds as the likes of Alibaba and Meituan. Let's bring in their senior equity analyst, Kai Wang. He joins us now. Kai, it's great to have you. I'm just wondering, in terms of the overall impact to Trip, what do you think this probe is going to bring for the company now?
Yeah, I mean, so the question right now is that they've been forcing local merchants to sign these exclusive deals. It's in China, it's called choose one from two, and so once they sign exclusive deals, they can't really sign with any other platforms. And once they have these, they're in these exclusive binding contracts. Then they kind of jack up the monetization rates or the commissions for these merchants. So that's they've been getting lots of complaints about that from local tourism industries, and this is kind of the main issue here.
And David here, by the way, Kai. Do you think it's priced in? Because shares have really taken a tumble, and I wonder what outcomes markets are pricing in. Really, a dominant player that's being asked to effectively don't be so dominant, if you think about that specific part of the practice.
I want to say it's priced in, but if you look at Meituan and you look at Alibaba and look at their peaks, and when Meituan was at their peak and they had a pretty large market share as well, and they still do, and you've seen how dramatically that that share price has kind of fallen from its peak in 2020, 2021. I think there could be a bit more risk for Trip as well. The question isn't the short term, but it's really how this kind of opens up the competition for maybe other larger conglomerates in the long term. If Alibaba or Tencent want to come in and start kind of going to the OTA platform industry, they can now, and they can also partner up with a lot of these local hotels. So, yeah, the question is more about the long-term, competitive dynamics for Trip.com more than it's the short-term.
And I don't know, is the best case scenario a fine from regulators?
The best case scenario would be a fine from the regulators. I think. We still think that its narrow moat's intact, and they still have a really good network effect of customers and merchants around China and internationally. But as I said, the long-term competitive dynamics is in question here, and so that's what we're fearful for its valuation. But yeah, so if it's just a fine and they get to keep their competitive advantage, that'd be great. But I think I think there is a shift in the competitive dynamics in the long term here.
It's interesting. You mentioned that what's more damaging is not really the fine, as you say, but really the potential for heightened industry competition. Yeah. How do you think this shakes up the industry in some ways? If they're losing a little bit of that moat, but still maintaining maybe the lead, are there potential winners here that can emerge as closer rivals?
So in the short term, I think they'll be fine, and I think you can use Meituan as a very good example of what kind of happens in the long term here, right? So. What we're seeing off Meituan is that you're seeing lots of subsidies amongst, the new competitive entrants, Alibaba, Ele.me, JD as well. And so what that does is when you start, kind of competing for market share, you'll start kind of issuing subsidies, and that kind of whittles down the margins. And you'll see margin pressure if this happens hypothetically in the travel industry, you'll see the margin pressures go down, you'll see margins go down because pressures from other competitors. And so this is probably the worst case scenario here, is that ultimately, their margins just don't recover to what it is now, and there's a secular downtrend in that metric there.
Kai, just very, very quickly, from the perspective of regulators, they're trying to do something good here for the industry, and I wonder, from a consumer perspective, how do they feel the end of this exercise?
That's hard to say. I'm not sure. I mean, this is good for consumers. It's good for the merchants as well. I'm not sure what the end game is here in terms of what they want. Obviously, China's going through this anti-evolution thing, so I don't think they want to kind of pressure the prices down too much, since they still want the they want the companies to actually make some money there. But yeah, from the regular standpoint, I'm not sure where they're going to draw the line.
Kai, have a fantastic weekend, sir. Kai Wang, senior equity analyst there at Morningstar. On that note, a quick glance at markets before we fold ourselves quietly into the weekend and see on the other side of it. On Monday, markets are slightly to the downside going into the last 30 minutes of trade onshore, last hour in the morning session in Hong Kong. We will see you all on Monday.